And so it's a clean slate and a fresh start for somebody to be able to have that credit rebuilding program.
To me, when I think of someone getting a financial advisor, it's not someone who's struggling. It's usually someone who's like, oh, I'm going to plan for the future.
And I'm able to help them with restructuring debt, freeing up cash flow for them so that they have more working capital for themselves and their families.
So today we have Jeremie L'Heureux. I thought it would be a good time to have him on. I think we're coming into a time where people are going to be struggling financially. I think it's kind of a balance sheet recession where people have been pulling equity out of stuff to fund their lifestyle for a long time, and that comes to an end at some point. So I think we're coming into that phase. You were in debt consolidation. I find it really interesting the way you can finance loans or auto loans up higher than the value of the vehicle. Personally struggled to get even a $10,000 line of credit when I started my business. So it's fascinating to me. I think it's a cool tool people can use, whether it's in a business or to get out of credit card debt. And I think if done properly, safely, which I guess you would guide them through, I think it can be a great tool.
Absolutely.
Why don't we just get started kind of with how you started in the business?
Sure, yeah. Well, first off, thanks for having me on the show, Shane. It's an honor to be here. And, really like a little bit about my background. So I'm from BC. Whole family's from Alberta, small town called Plamondon, about 2.5 hours northwest of Edmonton here. And, my great-grandfather founded the town. So basically, if you look at career paths, the industries, there was forestry, there was oil field, there was farming, and that's pretty much it, right? So then what did I do? I went into the trades and became a heavy-duty mechanic by trade. And that was great until it wasn't, right? So, the ebbs and flows of the industry. I was looking for something different. And so I got into the financial industry, got recruited into the financial industry by a great friend of ours. And then, a few years later, sought out an opportunity to basically merge the financial and the auto industry together. And started, a company with my one of my former colleagues now. And, things went so well, I started my own company. So, that's kind of how the L'Heureux Auto Group got started. Yeah.
Was that a big switch? Like I came from farming and then went into what were like the gym and real estate investing. So it was kind of two different things. Obviously, heavy-duty mechanic, you're more blue-collar, working with your hands. Took a lot of schooling to get there, I assume. Like you had to go through the trade program.
Absolutely, yeah. I went through the RAP program, then went to college and got my certifications there for sure. So yeah, it's a 180-degree switch.
Was it hard when you started in the finance, like getting used to working without your hands? Was that a...
Yeah, I mean, it was definitely a huge adjustment, right? Because you're going from, being an employee full-time to being an entrepreneur, right? So you basically have taken on multiple jobs at that point, right? So you got to kind of teach yourself how to be your own boss and to actually have those structures and those disciplines day to day, right? So it was a huge learning curve that probably took me another, I don't know, a solid year to really start getting into the groove of things. So.
Do you ever miss it, or did you like working with your hands?
You know what? I don't. No? I prefer wearing a suit than coveralls. So yeah.
Yeah. For me, for years we did the construction side of the real estate as well, so I always got to do it. And some days I still miss it. Yeah. It was fun to do it. Wouldn't want to do it full time, but
yeah. We have a lot of property out by Plamondon, and we have a bunch of equipment, farm equipment and quads and all kinds of sleds and toys and that kind of thing. So I like to tinker with my hands, and we have some side projects going on there. So, but other than that, for like the business aspect of things, no, I don't miss it for a career per se.
So what was there's a big disgrace to the family that you went into financing?
Not at all. No, thankfully they were very supportive. Like my dad, he works for a large forestry company, Alberta Pacific Forest Industries, is an executive there. So he has always had an apt for business himself. And so, he was kind of just following in those footsteps. And then my older brother as well is a financial broker too. So, it's just kind of runs in the family a bit. So. Thankfully, they weren't disappointed too much.
When you say your grandpa founded the town, what does that look like? Like he was the first guy there, or?
Yeah, so basically, a little bit about the L'Heureux family history is so we're aristocrats from France originally, and we were on the wrong side of history during the French Revolution, so we fled to the U.S. and we established ourselves in Michigan for about 200 years. And then right around the time that Prime Minister John A. Macdonald was giving out plots of land for about $10 a pop, our family established ourselves out here in the West. And the reason why we did that is because my great-grandfather saw that if they would stay back in Michigan, that they actually wouldn't be able to preserve their culture, their language, right? We're French-speaking first, our religion of Catholicism. So we established ourselves in an area where, we would be able to continue that forward. So I look up very highly to my great-grandfather because he's kind of paved that path for us in the next generation.
So is it still? Do you have kids?
Not yet. No, we're gonna start trying this year though. We're excited.
There you go. Well,
Yeah.
trying's the fun part.
Yeah.
So so that'll be a big thing that they speak French for you.
Absolutely.
Yeah.
Yeah, for sure.
Good. Anyway, so about the product that you offer, or kind of the services, how do you, very briefly describe what it is, and then we'll kind of jump into it.
Yeah, absolutely. So basically, like my company, L'Heureux Auto Group, I'm contracted with a couple different dealership groups here in the city. And one of the main, things and products that, I offer that we're going to touch on today is auto refinancing. So we are able to consolidate high interest unsecured debt into your vehicle loan. Free up cash flow month to month for clients. So I work with a lot of professionals like mortgage brokers, financial brokers, and they refer their clients to me, and I'm able to help them with restructuring debt, freeing up cash flow for them so that they have more working capital for themselves and their families.
So do you find, because honestly, when I first heard what you did before I talked to you, I would have probably thought kind of like not a shark, but you know what I mean? It's like somebody like, oh, you're coming in, but then it's going to be a high interest thing, and it's going to be a burden on people. And I've talked to you since, and I think it's actually it makes sense, right?
Absolutely, yeah. I mean, if you're looking at somebody, let's say they're paying off a credit card at 20%, which is the standard rate usually, and now they're paying it off at 8.99%. Well, that's a big difference, right? We're able to save a lot of money on interest overall. In most cases, and then also on the monthly payment, right? The other thing too is that you're going from having multiple debt payments in a month and bundling it now up into one, right? So you're bundling everything up into one. So instead of having like 3, 4, 5 payments, you now have that one payment, right? So it just kind of cleans things up a lot, right? So it helps to free up TDSR, right? And so, like, for example, let's say you have like a mortgage broker who has a client and they've got a vehicle that's financed on an unsecured line of credit, let's say at, 14 or 15%, and I can actually put that onto an open-ended loan, right, at, 9% and free up that line of credit payment and then just have the open-ended vehicle loan. Well, that could help them get pre-approved for a mortgage as an example, right? So those are some different avenues that we help people.
What is TDSR?
Yeah, it's total debt service ratio. So that's, the expenses versus, the income, what's coming in, what's going out.
And how does it look on someone's credit? Like if they have it makes it a lot better than if they have just the one line of credit? Does it for their credit rating, let's say?
Absolutely, yeah. No, like I said, it just cleans up the credit report, right? So instead of having multiple trade lines open on someone's credit report, they just have the vehicle loan, right? The other thing too is that credit utilization is reduced because they have less trade lines open, right? Which that also accounts for someone's credit score, right? And so credit utilization actually accounts for 35% of someone's credit score. So that's huge, right? So when you're looking to, let's say, get pre-approved for a mortgage, if you're a mortgage broker client, that could be something, an avenue to look at.
Because I don't think people understand credit scores very well. I do a little bit better now, but so how do people get their credit up? So if you had 5 credit cards at $10,000 each, or you had one at $50,000, it's way better to have the one.
Definitely would be a little bit better to have the one, but the other thing too is credit utilization is really what's important. So what percentage that you're actually using the credit. So the industry standard, they recommend between 0 to 35% utilization. So let's say you have a $10,000 credit card limit. You don't want to typically exceed $3,500 And the reason for that is that it indicates that you're using the credit that you're being given, but you're also being responsible with that credit that's being extended to you. And so that's a big key when it comes to credit.
So if you go all the way up to the 10,000 or on the credit card and then pay it off every month, that doesn't matter. They're still seeing that you're going up, or is it just if it sits there?
So that's a great question, Shane. So basically, like if you're, let's say, going right to the maximum limit, that's going to obviously decrease your score because your utilization is significantly higher, right? And so even if you're racking up your credit card and then paying it off every month and then racking it up again, you're still going to have a lower score rather than somebody who's keeping it at, let's say, 3,500 or 4,000, letting it sit on there for a bit to show that, the credit card that you're actually using the credit that you're being given, because credit card companies want you to use credit, right? They don't want you to not use it, but that you're being responsible and that you're paying the credit card on time and, multiple payments in a month instead of just that one payment.
So then if you had two $25,000 ones or 150 and you kept one at 0 or 10% and one up instead of would that be better? Do you know what I mean? Like for the way they're looking at it?
Yeah, so I see what you're saying, but again, it's all about like the utilization on the individual card itself, not the combined amount together.
Yeah.
So it's per card. And so if we're freeing up that trade line, which would be a credit card on a credit report, then that helps to increase the score.
Yeah. So what are other things that people probably don't know affect their credit a lot?
So credit utilization is one of them. Repayment history is another. So most people don't know this, but actually if you have, let's say, a monthly payment like a cell phone bill, that's a monthly payment, and you don't make your payment on that date that it's supposed to be set, it's not going to hit your credit unless you make that payment within that 30-day window, right? So people aren't aware of that. But just making your payments on time is a huge one. Credit utilization is another. And then multiple late payments, repossessions on, vehicles and write-offs on different like credit cards, lines of credits, those kinds of things. Those really affect credit in a big way.
And what about like I got told once that it was like how long you've had something. So I still actually have like the credit card I got when I was 18.
Yeah, absolutely. That's definitely a factor for sure, that like a lender will look at what length of time someone has, let's say, this credit card for. Like, if you just came to me and you're looking to get a vehicle loan and you just got a credit card 2 months ago and you don't have any other credit history, then, the likelihood of you getting approved on your loan by yourself is probably not likely, right? You probably need a cosigner in that instance. So definitely the repayment history and the duration of that, let's say that length that you've had that credit card, yeah, that's a huge factor too, for sure. That's a great point to make.
The one thing that always kind of fascinated me is there's no way they look at, like if someone does cosign, but that same person could cosign for 20 people and it doesn't affect their credit at all, right?
It depends, actually. Yeah. That's another great question, Shane. So basically, it depends on the lender. There are some lenders where if you're a cosigner or you're a secondary on the loan, that it might not even show up on your personal credit history. However, there are other lenders that it will show up on your credit history. So you can't cosign for 20 different people. Usually, obviously it's based on your own personal credit strength, but usually a maximum of 3 separate co-signing loans.
Oh, but it does show up on theirs usually.
It does, yeah. Some lenders do not report it, and some do. So, but most of the lenders, it does show up on your bureau as a joint application. Yeah.
So, is some of what you do when people come to you? I assume the majority of them don't have great credit, right? Because they're in an issue, Or is that not the case?
No, that's not necessarily the case. Like, we work with people with all ranges of credit. I have, people that come to see me, they have still like really good credit, but they just need help kind of debt restructuring solution, right? And then we have other clients that come to me, their credit is not so good, and I can still offer solutions for them. It's just that the interest rates on the loans are going to be reflective of someone's credit, right? So it's, typically I'd say it's about a 40% lower credit score clientele and 60% that have a little bit better credit scores, because these are a lot of the business that, I work in is from referrals from financial brokers, and so they've been already qualified as a client, and so their credit scores are typically a little bit higher.
Because do you help with that, like the coaching people to get their credit score up so they can get?
Absolutely, yeah. So I always, share tips and education on things to do. I'll share a story about that. We had a friend of ours, Sandra and I, that's my fiance anyway. So we had a friend of ours that she was paying off her credit card as soon as she used it, right? And she's like, I'm paying my payments. Like, why is my credit score so low? And that's because as soon as she would use it, she'd pay it off right away. So it wouldn't even register that she'd be using the credit that was extended to her. And so it's basically like you have a credit card and you're not using it. Of course, credit card companies, like I said before, they want you to use the credit, right? And so that's one thing that I was like, okay, well, when you do use your credit card, let that balance sit on there for about a week or two so that it actually registers that you're using your credit, and then pay it off in full, right? And repeat that process. And she did that, and 6 months later her score went from being in the mid 400s to the high 600s in prime credit. So from subprime credit territory to prime credit territory. So, but yes, always providing coaching and education as to this is the different things you can do, Mr. Client, to increase your credit score.
So it can move pretty quick then.
It can, absolutely. Yeah. I had a client that I was unable to help back in July of last year. Their credit scores were in the mid 500s, and they just didn't have as much equity in their vehicle to be able to consolidate some other debts. And I was actually able to help them just this month because their credit score was in the mid 600s. And we had a little bit more equity to play with there because he had paid the vehicle loan down as well.
And does it have to be a vehicle, or can it be a boat or a sled? Or
Yeah, so I work with power sports and RVs as well. So side-by-sides, boats, quads, sleds, those are different assets that we can do that for sure.
And it still goes up, because I think you said on a vehicle you can go up to like 160%.
That's right, yeah. So basically looking at like borrowing power, we can borrow up to, depending on someone's credit strength, up to 140 or 160% of the vehicle value, right? And same thing, rules apply for RVs and boats and quads and that kind of thing.
Yeah, that's wild to me that you can what's the thought on the lender side, lending more than the things?
Well, in a regular vehicle loan, lenders on prime credit extend sometimes over 200%. So if we're just looking at the actual selling price of the vehicle, because that's what we're talking about here, right? We're looking at what they have left owing on their vehicle loan, and then whatever equity that we're adding, that we're consolidating, we add that on top of what they owe. And so, on a prime loan, lenders go north of 200%. And so if we're looking at 140 or 160% just on the selling price, we still have that margin on the back end within that 200 loan to value range, if that makes sense.
No,
so
I just don't follow the on the 200%. You're saying that's with the interest.
That's
in
the
there?
total amount financed of the loan. That's what they'll go up to. Yeah. So that's not the interest that they be paying over the course of the term, but that's the selling price plus all the extended warranty and all those kinds of things. And then the GST and everything like that added, and then you have your amount to finance at the end of it. And then, so that's what that 200% would represent.
Oh, yeah. And are the actual lenders that you're using, are they the same as the dealer's using? Are they different?
That's right, yeah. TD, Auto Finance, CIBC, Scotia, RBC. Yeah, all the prime lenders, and then subprime lenders that we work with as well.
So how often do you see not people that necessarily come in with maybe it's not credit card problems, but I know lots of people, like when I first got out of high school, that would go get vehicles and they'd take 20% loan. They wouldn't know. And they're like, hey, the payment's only this amount. And they'd take like 18% interest on a vehicle. Yeah, no, I mean, we have, clients that come to me with, originally they had way higher interest rate vehicle loans, and their credit has since improved. And I've been able to refinance their loan at a way lower interest rate and save them money on over the course of the term, and also on the payment as well. And so those are some of the things that I'm able to do as well.
And then also, let's say you have somebody who is in a vehicle payment that they cannot afford whatsoever, and there's so much negative equity in the vehicle that they would just never be able to get out of it, right? They owe way more than what the vehicle is worth. Then what we can actually do, Shane, is we can surrender that vehicle into a consumer proposal, wrap up all the other debts along with it, right? Because they're never going to be able to get out of that anyway. And so it's a clean slate and a fresh start for somebody to be able to have that credit rebuilding program. And we work with lenders that specifically have programs for people that are filing for a consumer proposal and surrendering their vehicle. And then we help them get into another vehicle loan through those programs, to be able to get into a vehicle that makes a lot more sense for them and to help rebuild their credit.
What's the difference? Like, is that just like the same term? Is that just bankruptcy? What's the difference?
It's a consumer proposal is under the Bankruptcy Act, but it's not a bankruptcy. No. So essentially, like, you're going to be surrendering the vehicle to whoever the lender was. And then let's say you have credit cards and loans. Then what's going to happen is the trustee is going to negotiate to the creditor a lesser amount that's owed. And then there's going to be a payment that's, based on whatever that they renegotiate. And then, of course, I have to also factor in what that new vehicle payment will be and make sure that that makes sense with the consumer proposal payment and the vehicle payment. But that's another avenue where if people just don't have a way out or they don't see a way out, that they have that option, and we can help them with that.
And how does that affect your credit if you do that?
Yeah, that's a great question. It's going to, affect your credit. Definitely it's going to drop your credit. But the thing is that it's way better than filing for bankruptcy if there's no other option. The other thing too is that consumer proposals, you can actually build up your credit a lot faster. So if you 2 years after you've made your last proposal payment with reestablished credit, you can qualify for prime credit again. Versus, if we looked at a consumer proposal several years ago, it would take over 10 years to be able to get back into prime credit territory. So the turnaround time is a lot faster. And this is a great option for somebody who is just in that position where they feel like they're backed into a corner and they don't have a way out. And there is a way out. There is light at the end of the tunnel for them.
And what do you see when you put the proposal together and you, what do the terms look on the other side? So you have a $50,000 car and $50,000 of credit cards. Are you getting that down to, how much do they usually come down?
It's a great question, Shane. So that's a case-by-case basis, and it would be the trustee that would be doing that. That's not something that we take care of. That would be the debt consolidation company and the trustee that we refer the client to, and then they refer that back to us for the vehicle situation. So it all depends. It's not a set parameter on, if somebody has $50,000 of credit card debt, it's going to be reduced down to 18, right? It all depends on the specifics of the file.
And then the terms of the new loan, are those 8-year loans? Or are they 5? Or they can be anything?
Are you talking for consumer proposals?
Yeah, when you get back that lump, now you got to pay everything back.
Yeah, so typically a consumer proposal is between 3 to 5 years. That's usually the term that they spread them. They can do a 1 year, they can do a 2 year, but usually 3 and 5 years are the loans. And so I like to obviously take and factor those in when I look at looking at the new vehicle loan and structuring that.
But then how could someone, if you had, let's say it's $100,000 of, the car and the credit cards and everything, and then how could you ever pay that back in 3 years?
Yeah, so again, it's the trustee that's negotiating on behalf, to the creditor at a way lesser amount, right?
Yeah.
And then so that's all factored into the payments and everything like that.
And then there's never an issue you getting them a car after if they're...
Typically, no. There are, again, it is a case-by-case basis. So what I like to do is I have a close relationship with my, trustee referral partners. And so they actually send me the creditor package. So that's the consumer proposal package. And then I send it into my lenders that I work with to make sure that I can get the client approved before we actually sign the consumer proposal agreement, right? Because I never want to be putting a client in a position where, yes, we're able to do this, and then we're not able to get you approved for another vehicle loan, and they need a vehicle, for their day-to-day life, right? So that's, a way to mitigate that. And also, if someone has strong enough credit where they can actually get pre-approved for a secondary loan, a secondary vehicle loan, right? And so we wouldn't even have to, go through lenders that work with clients that are consumer proposal. We basically get them approved for a secondary unit as a prime client, and then they surrender their vehicle into the proposal, and we're able to move forward with the new vehicle loan. So we can work with people that have good credit and they need to go into consumer proposal, and clients that have not so good credit.
And on the other product where you're just consolidating stuff into a vehicle loan and it's going up to, the 160%, that you said there's some parameters on what the vehicle is, right?
Absolutely, yeah. So we can't finance anything that's 10 model years or older, so it'd be a 2014 in today's day and age. And then anything like 200,000 kilometers or more is typically more difficult because the kilometers are a lot higher. So the term from the lender is going to be a lot shorter. So then in most cases, it doesn't make sense, right? So if you have like a 2014 with 220,000 kilometers, your term is going to be 24 months. And it's typically not going to be able to free up too much cash flow within, having a loan spread over 24 months with, let's say, 9% interest rate, right? So yeah, anything over 200,000 kilometers, it's not doable. It just depends on the year of the vehicle. That's one of the factors. And then, employment, income, credit, those are other factors as well.
So on the employment, doesn't matter how long they've worked there? Is that the...
So job tenure is a factor, but also income, right? So they need to be able to afford like the overall payments of everything together. So we look at that as well.
And on the vehicle they get coming out of the consumer proposal, does it have to be anything special?
It has to fit the program approval that the lender gives you. Like if we're working with a client where we need to go through those lenders, they come back with a pre-approval. So either a monthly payment or an overall amount to finance, and then we find a vehicle solution that fits within those.
Have you found, have interest rates made this a lot harder going up?
In terms of like the debt consolidation, no, truthfully, because, again, if you have a credit card at 20%, 25%, you're now paying it off at 8%. That's amazing, right? In terms of people just in general buying vehicles, yeah, definitely, because a lot of people don't want to be buying vehicles, at higher interest rates than what they were, 3-4 years ago. But another nice thing is that there's always an option to refinance when interest rates do drop, right? So, and that's something that I always mention to my clients is, if we do a refinance to consolidate that debt, yes, you're paying it off, let's say at 8 or 9%. But then, when rates do drop, let's say a year from now, we can also refinance at that time and get that rate lowered as well to further accelerate paying the debt off.
Hey, just wanted to jump in here and say, if you're watching on YouTube, subscribe, give us a thumbs up. If you're watching on a different platform or listening on a different platform, follow, give us a rating. It really helps get the show out to a bunch of new people. So when you do the auto refinance loan, do they check that you paid the credit card off or?
Yeah, that's a great question, Shane. So like a lot of my clients that I work with, they're referred to me from a financial broker or a financial advisor. So I asked the financial advisor to request like a receipt that they actually paid the credit card off. Because as you can imagine, you get this credit card, 10 grand freed up, and then boom, you can just rack it right up. And people have done it for sure, but just that accountability piece with a financial advisor and their client to be able to do that. And then myself, if it's, someone from the public, I ask for the same thing, just to have that extra layer of accountability, because at the end of the day, we're here to help them. We're not here to, free that up for them to just rack it up again.
To me, when I think of someone getting a financial advisor, it's not someone who's struggling. It's usually someone who's like, oh, I'm going to plan for the future, not I need to pay these credit cards off.
Yeah. It's a great question. It depends on the scope of clientele that the financial advisor is taking on, right? There's some financial advisors that they work with middle income class Canadians. And within that is a range from, you could be working with a customer that's making, $30,000 a year all the way up to, 6 figures plus, right? So there's a huge range. And within that comes those different opportunities for the services that I offer.
And how, I know this isn't your thing, but how do they charge? Like if someone wants to go get financial help, you would just think, oh, that's going to cost me even more money then.
Yeah, no, that's a great question. So it's actually, they get paid by the companies that they broker out to. So there's no upfront fees or anything like that for the customer or the client to work with a financial advisor. So yeah, it's all paid from the back end.
If someone comes directly to you, like how much help is there from you? Like, are you sitting down and helping them budget, or is it?
Yeah, so I'm also a licensed financial broker. So in addition to helping them with the vehicle solutions, I can help them with their personal finances, insurance, investments, all those kinds of products and services. So yeah, we look at what we do an information gathering. We look at what their overall financial situation is, and then we look at what the client wants to do, what are their main goals, and then we tailor and build plans based on those recommendations that we have for them.
Do you ever do any kind of like workshops where you teach?
We do. Yeah,
Yeah.
we do. Yeah. Every couple of weeks we have at our office in South Edmonton, we invite guests to come out, and we do financial workshops to teach people about money and finance, how it works in Canada.
And how are you getting those people to come? Like, how would they?
A lot of it is word of mouth, organic referrals from existing clients is more so what it looks like. Yeah.
And that you're teaching them on the like investing side, or what goes on?
Yeah, great question. So really on everything that has to do with money and finance. So insurance, life insurance, critical illness, disability insurances, investments, TFSAs, RSPs, non-registered accounts, all those different things. So yeah, so basically anything and everything to do with your personal finances.
Do you talk about the auto loan thing or not in those?
I do trainings for like brokers and their teams, but I haven't done an actual client presentation. That's something that I'm working towards right now. So
yeah, I think it'd be good. Like when I started my first business, and it was always funny to me because we got a loan for the building and the land to build it, and then when we wanted a $10,000 line of credit to get supply, it was a gym, it was a supplement store. You couldn't get it. We had no business credit, and there was nothing to lean on.
Right.
And then that's when I hear how you can leverage a car this much. It's always interesting to me, and I think there would be people that could use it for whether it's their business or just if they get in a jam. Even in their business, I'm sure they could pull equity out and use it.
Absolutely, yeah, and I mean that's a great thing. That's not something that I do too often, but the option is there, right? If they needed to pull equity out of their vehicle for business expenses, to get a business going, to invest money as an investor, those are different avenues we can look at. I had a unique situation actually a few months ago where a client was referred to me. They needed to go bury their father overseas. They didn't have the capital to do it. And so we were able to pull the equity out of the vehicle that they owned free and clear, and give them the equity and the money that they needed to be able to go overseas and take care of what they needed to take care of there. So there's so many different facets and avenues that this works. It's not just one lane. There's all kinds of different opportunities with this service.
Yeah, probably where I think in the next couple of years, well, I'm sure you're aware, or we'll see this, but I think a lot of people have been living in a cycle where when their house loan comes up, they pull money out and they fund themselves for a couple of years, and then they do it again and again. And I think interest rates will stay higher for longer, not as high as they are, but they're not going back down as quick, I don't think, as people think.
I agree with you there, yeah.
And then that comes to an halt pretty quick, because people who had 1.8% interest loans that are coming up at 6, and even if they're 4, your equity that you could pull out, you're re-amortizing that into the loan. So I guess it'd be good if they have that option or know about that, I guess.
Just another avenue, exactly. Yeah.
What percent of the business would be vehicles, and what would be like RVs and boats? And
so I definitely put a lot more focus on vehicles. It's just in about a year ago now that I've started talking more about the RVs and the boats and that kind of thing. So I'd say it's about 80%, 20%. It's underutilized, and that's something that I'm putting more emphasis on now. Is hey, we have this whole other set of avenues that we can these other assets that we can pull equity out of. So
But wouldn't it even make sense to take your sled loan and put it on your, like, aren't those ones usually way higher interest? I don't buy them, but
Yeah, so again, it all comes down to credit as well. Right now, interest rates on power sports are higher, so it would be a case by case basis for sure. Obviously, I wouldn't recommend, putting a credit card, let's say at 20% down to 15%, because that's probably not going to make too much of a difference, right? So if it's not good for somebody, I'm not going to recommend it, but I'm going to look at their whole scope of what's going on and then make the best recommendation based on, what would be the best solution for them moving forward.
so I guess if someone comes in, they get like, if back to the building credit thing,
Yeah.
what's like, because you'd use the one example of the girl, but what are some other, like, what's the fastest way someone, if they want to work with you, but they're like, we need to get our credit up? It's that utilization, but they can't pay their stuff down.
Yeah, the utilization and just making sure that they're making at least the minimum payments, right? Most people are able to at least make their minimum payments. Most of the cases I've seen, people have been able to make their minimum payments. They just have some lifestyle spending habits that are not allowing them to make those minimum payments. But if you look at their overall budget, they do have the room to do that. So it's a matter of having that mindset shift, right? And you have to understand, like, people are in a situation a lot of times because of the mindset that they go into. And so we're here to not just help them with the physical application of these things, but also the mindset behind it, and help coach them towards making those shifts so that they can actually get further ahead.
So if someone doesn't have a job, like they lost their job and now they're in this problem, is it pretty unlikely they're getting?
It's unlikely, because the lender will typically want to see proof of income, and if you have no income to show for, there are some exceptions. Sometimes if a client has strong enough credit where the lender doesn't ask for proof of income, let's say somebody who was on mat leave, that's an example. Like, they do use a portion of the mat leave as income, but it's not the full portion. So in most cases, it doesn't qualify enough on the income side of things. But yeah, if somebody has strong enough credit, typically a lender, they won't need to ask for proof of income. So those are some of the avenues we can get around that. But if somebody has lower credit and they don't have a job, then it's just basically not a good situation there. So.
And does unemployment count, or like disability? Do those count?
So they take a percentage of that income, so they don't account for the full percentage. Same as child tax benefit for mothers. That's another source of income that they do factor in, but they won't factor in the full 100% that person's receiving.
So you were talking about making the minimum payment earlier. How long does a credit card, if you stop making it, how long do they let that go before you're?
They're pretty quick on you, yeah.
And then what do they do, though?
Yeah, they'll send it to a collections agency,
and
then that goes as a collections on your bureau, and then that obviously affects your credit. So, so if you miss 3 payments back to back, and there's no communication between you and the lender, then they're going to send that to collections really quick. They're going to reach out to you and notify you of, hey, you didn't make your payment, right? And they give you an opportunity to make that payment. But if there's no reciprocation back from, your end, they're going to send that to collections really fast.
And then does that help at all when you go to refinance a vehicle? If you're like, look, there's this on their file, they haven't made that payment, but we're paying it off, or that doesn't help their case?
I'm getting to that, actually. It's great you mentioned that. So if I come across clients, let's say they do have a collections on their bureau, that's one of the things we look at, is paying those off first, because that's going to help increase their credit significantly, right? Unfortunately, what people don't know, though, is that oftentimes they pay their collections off, but then it stays on their credit bureau. And the reason for that is because they need to actually contact either Equifax or TransUnion and send a letter showing that this credit agency has their fulfilled payment and they're happy, and there is no further, they're not requesting any more money. And then they'll take that off the bureau, right? But most people are unaware of that. So that's something that's really important for people to note, that, if you do have a collection and you paid it off, make sure you send that letter into Equifax so that they can get that off your bureau, so that it boosts your score significantly.
So those are the only two companies that do it?
Yeah, so most lenders, they work with Equifax first, and then if there's a discrepancy on the Equifax, then they look at TransUnion. So Equifax holds 7 years worth of credit history, and TransUnion holds 10 years worth of credit history.
So does it make a difference? Because we take people to collections with our business.
Mm-hmm.
And if, let's say, we get a call that they want to pay, they want to pay it off, but they only want to pay a portion, does that show up on there?
Yeah, it's still, like, the total collection is still going to be on there.
No, but I mean, like, let's say we sign the thing, so they're happy. We're like, yeah, we're happy, we're paid off. Okay. Then it's good to go, or will it show that they only paid 30% of it and got out?
No, if you guys are like, if whoever is requesting that amount to be paid is satisfied and it's in writing, and they send that to Equifax or TransUnion, they can get that removed. As long as the person that's asking and requesting for the money is satisfied, that's the main thing, of course.
So when somebody goes bankrupt, right, and then you essentially that will stay on for 7 years.
Correct.
But can you build your credit way up during that time, or like, I know you can a bit, but will it always be like a red flag for everything for 7 years?
I mean, so obviously lenders wouldn't be in business if they wouldn't be able to help people that are still have write-off loans, that have been in bankruptcy previously, and those kinds of things, right? So they do have programs for those clients. It's going to restrict things a lot, where they're only going to be able to work with like a C or a B level lender. But it's not like they won't be able to get ahead. Like, they still will be able to qualify for vehicle loans and those kinds of things. But they're going to be restricted as to the amount that they're able to borrow, and those payment, right? They look at the monthly payment, the amount to borrow, and they're going to be restricted within those parameters.
And do certain things, like if it's a credit card or a vehicle or a house, like, does it hold more weight, or the amount? Like, if they have something on their credit negative, does the amount play a big role?
The amount is definitely a huge factor, because that also comes into play with your total debt to service ratio, right? So how much, right, and your credit utilization. So how much credit you're utilizing versus what you have access to, right?
But let's say you have a vehicle that's worth $100,000 and you owe $50 versus a credit card that you'd have $50 and $25 on there. Are those looked at the same as far as your credit?
Well, a vehicle loan is looked at differently than a credit card, because it's a larger asset, right? So it is looked at a little bit differently there.
Better or worse?
Definitely like to a stronger regard for the vehicle.
And a house even more then?
Yes.
Usually.
Yeah, because, typically vehicles and houses are the largest purchases that people will make over their lifetime. And so, yeah, they're looked at to a higher regard for sure.
So how did you decide to get into, like, obviously if you're a financial advisor first, how did you decide that this was kind of going to be the avenue you took?
Yeah, it's a great question, Shane. So basically, like, when I was a financial advisor, I saw that the brokers I worked with had all of the solutions except for vehicle solutions. There was no real vehicle solutions at all, right? And we didn't have any kind of established referral partnerships for that. In my career as a financial advisor, had referred somebody out to a dealership to be able to lower the vehicle payments, and they actually oversold them into a bigger vehicle with way higher payments than what that person needed and could afford, right? So I found that that need with one of my former colleagues. We found that need, and we just kept building on that, and it is where it is today. So
what percent of the auto loans that come in do you think have been done that way, like just kind of shady? Because I hear a lot of that where it's like somebody goes in and then they get just told it's one price and they upsell them. And
yeah, unfortunately, the traditional auto industry, I mean, obviously they're there to make money. They're one of the most profitable industries in the world. And they get people hooked on the emotional sell of the vehicle, right? Shane, you work hard for your money. You deserve the best. Let's get you upgraded because you deserve it. And then that's where people, run into trouble. And so we're working to reverse that curve. And really, like, what the auto industry is failing to realize is you're working yourself out of a market. Because if you have a client that buys a vehicle from you, and then 2 years later, you get them traded up and upgraded, and they roll negative equity over onto their next vehicle loan. Well, they do that 3 or 4 times over, and they're not able to get into another vehicle because they're in that negative equity position that we were talking about earlier, and they have to start from scratch.
Do you think in the auto industry there's changes coming? Like I've always heard the dealers get, they hold a lot of their inventory on very low interest lines of credit and stuff, and that's now rolling into, in the next little bit here, a lot of those will be rolling into higher interest ones.
Yeah, definitely. So I mean, that's just it. Is there's definitely there are dealer groups out there that are innovative, that want the change, and they want to help clients. But there are some that are still stuck in the old way of thinking, and that they still are doing things the old way. So there are people out there that I know personally in the auto industry that are making a shift for better. But we need more people for sure.
What do you think in your industry? You can obviously, you're good at talking and selling the product. What did you take any training for that or anything, or just did it?
No, I always had a knack. Like I love helping people. I always had a knack for business, and it's just really come from the passion of helping people, right? And so I never took any like formal training. There's certifications along the way, of course, from being a financial broker, and you have to take a small course, AMVIC license regulated course, to be able to work in the auto industry. But a lot of it is self-taught, truthfully, and just a series of trial and error over the years, and having great mentorship and great coaches along the way to help you out.
So when a client comes, what's that process? They come to you in lots of trouble. What is like the first, what does that process kind of look like?
Yeah, so we're going to have an initial phone call, and we're going to do like a discovery call, gather all the information, their personal information, their credit information, vehicle information. And then after that, I basically assess the situation behind the scenes, myself and my team. And then, we get approvals in place for the new proposed option. And then we get together with the client either in person or on a Zoom call as an example. And we go over the proposed plan together. And then once that's done, then we implement it with the lenders. We send the appropriate paperwork in. And then, usually takes 5 to 7 business days for the lending process to be funded, and then we're able to give the customer the equity back in an EFT or a direct deposit into their account.
So within 2 weeks,
it's usually very quick turnaround time. Yeah.
And on the consumer
proposal side, yeah. So I mean that could be a little bit longer because there's usually quite a few moving parts within that. But I work direct. Some consumer proposal companies, they're kind of the middleman, where they have to talk to a trustee, and then the trustee then talks to the creditors. But I work directly with a trustee, so they're the ones doing the negotiating right away. So it's usually a more effective process. And the trusted referral partnerships that I have, they're very diligent and on top of their files, and the ones that I've been able to do successfully, it's been 2 to 4 business days turnaround time for that.
But then how long till you get till you get the
for
proposal?
The consumer proposal package put together, and then after that, then it's another day or 2 for the lending process.
So within a week you're out.
About a week, yeah.
Really?
Yeah.
That's crazy.
Yeah. Some it can take longer, right? It depends on who you work with too, right? I've had instances where it's taken over a month. It just depends.
But then they're out there, cars back, they've given up the cards.
In some cases, yeah.
That's crazy fast.
Yeah.
Because I'm used to dealing with like buying buildings where 90 days is short.
Yeah, it's a different. It's a little bit faster than what you're doing for sure. So.
But I'm just surprised because if you're trying to get a lesser amount, if you have a $50,000 car and you're trying to pay off whatever the amount is, $30,000, that the dealers would accept that so quick, or I guess the lender who took it.
It would be the lender. Yeah.
Yeah.
So, and I mean, it's all the relationship between the trustee and the lender, right? But it's a pretty quick process. But again, it depends on who you work with, just like anything, right?
So do they look in that process? Do they look at your credit, or they don't care then?
Yeah, they will look at your credit. Like there is just some, credit where it's just like they're not like if you have a 300 credit score, like I think that's the lowest you can qualify like for, a credit score. I think that's the lowest you can have. They'd have the option to reject, but I mean they wouldn't have an option to reject because it wouldn't make sense business wise because they're in the debt business anyway, right? So they take on most customers.
Why would the minimum be 300? What would you have left?
That's a great question.
Why when they started at 0?
I don't know. 30%.
Yeah.
Right, because that's what it accounts for is if let's say you have a 760 credit score, you're more than likely to be paying your bills on time 76% of the time. So I guess 30% is 0 in this scenario.
So what's a high credit score?
High credit score for vehicle loans, specifically refinances, those kinds of things, like 730 plus.
And that's only saying you're paying them 70% of the time?
Yeah. Yeah. But the highest credit score is 900.
Yeah. That's only 90.
Yeah.
Yeah.
So they never give you 100%.
Well, they don't give you, that's a lot
it's
lower
always
than
an A and not an A plus, Shane.
Well, that's
always
better than starting at a B at 300 though.
It is.
They need to give zeros.
Yeah.
Start at 0.
That's an F.
Yeah.
300 is an F.
So you mentioned the mentor thing. Who has that been for you?
Definitely quite a few along the way, but most recently Ben Spangle. I've been working with him one-on-one for coaching. He's got a great coaching program and a great group mentorship program as well. So my dad's been a mentor of mine, and my older brother too. Like him and I have always been really close, and he's successful in business. So I've learned a lot from him along the way. So those are one of the main people for sure.
Is there anyone outside? Like for me, it was Grant Cardone was a mentor of mine. I would read the books. And
yeah.
Is there anyone like that? Or
yeah, definitely. Like I've studied Grant Cardone. Evan Carmichael's been one of them. Ed Milet. I'd say Ed Milet probably out of everybody would be a larger influence there from a distance for sure.
Yeah.
Yeah.
Yeah. He's always been a big one.
Yeah.
Any books you'd recommend for people? Or
yeah. I think Think Like a Monk is a really good one by Jay Shetty. It really dives into like the actual mindset and the spiritual side of things, which is something that in order to be a successful entrepreneur, as you know, you need to be able to master yourself internally before you master the external. So that's definitely a good one for sure.
Cool. Is there anything else you wanted to cover?
No,
we missed.
I think we've covered lots today, okay. So I think it's good, man.
Good. Is there? How does someone get a hold of you? What's the?
Yeah, for sure. So you can follow me on Facebook, Instagram at Jeremie L'Heureux, and then also reach out to me. We can put in the show notes my contact information, that kind of thing. So.
Okay. And do you have, if someone wants to work for you, do you have?
Yeah, absolutely. There's opportunities. Yeah.
Thanks for listening. Hopefully you guys liked the show. If you want to reach out, let me know what kind of topics you'd like to cover or guests we'd have on. Send me a message on Instagram and we can chat there.